Folks, yes, yes, yes. He is back. He had a couple of weeks on a family vacation, but the one and only Mr. Dan Bird is back to talk about the stock market charts, what is going on. We are going to do two videos today. One, we're going to catch up where we've been, and then we'll talk about where we are going. Mr. Bird, the audience has been missing you.
I have been missing them as well. I was in Montreal, Vermont, and New Hampshire, which was nice places to be in the summertime.
Yeah, yeah. Very, very cool. Well, we've missed a couple of weeks.
Plus, I had to collect some more Starbucks mugs.
That's right. Yeah, you have a very impressive collection. We'll show that someday. But it's been a couple of weeks. We had a jobs number last week. We've had some, earnings over the last couple of weeks. I don't know what you want to catch us up on.
And don't forget the Fitch downgrade.
Oh, the Fitch downgrade. So much stuff happened in the last 2 weeks. I can't wait to see what's been going on in the markets, what caught your attention. So catch us up.
All right. Well, I haven't been doing much because I've been on vacation. So I went mostly to cash. I think the last time we talked and a couple of times before that, I said it looked like the market was flattening out and there was some negative divergence, which I'll show today, which implies that the market is running out of steam, basically. Momentum's running out of steam and it's getting ready to roll over, which it has now. We'll see how long that goes for. But we're in the summer slump right now.
Yeah.
So the market typically, earnings are going to probably be ending the next couple of weeks. And then there really isn't anything. There's a Fed meeting in September, which we'll talk about that because next week is the CPI number.
Yeah, CPI and PPI. Yep.
Yeah. That might have an effect on things as well.
Okay.
But in general, I expect things to be somewhat volatile, maybe go sideways, go up then down and up and down. I'll show you an example of 2011, the last time there was a downgrade of US debt.
Oh, awesome. Like. Let's take a look.
Okay, let me share. It might be a little out of practice because, it's been 3 weeks since I've been doing this.
It's okay.
Oh, what do you got here? First off, if anyone's interested in getting my newsletter that I send out every weekend, I probably will do it via email for one more week.
Yep.
And email lately has basically been a PDF attachment. And then it's going to be on my website for free at breakpointtrading.net.
Yeah, you've gotten so many fans; it's just become unwieldy. Your email provider is going to call you a spammer. So it made sense that you would invest and get a website. Just go to the website, breakpointtrading.net, and sign up to get the free newsletter.
Yep, exactly. And there's a lot of other content out there if you want to, sign up for a subscription, an annual plan, which is pretty cheap. It's less than $100. But there's a lot of stuff. I'm going to actually use that from now on our calls like this because it's so easy now for me to pull up charts from there. So we'll look at that in a second. But the Fitch downgrade, this is one of the cartoons that was in the newsletter this week. Downgraded from a AAA to an AA plus. So we can talk about that.
Okay.
First off, here's what happened last week. So the jobs number was, it was pretty flat, really. It came in a little lower than forecast, but it came in pretty much almost exactly the same as last month. So last month was 185 and this month was 187. Interestingly, the unemployment rate went down, ticked down slightly. So this is one of the key things, probably the first thing that I'm going to be looking for to see if a recession is looming, is if we get a spike in this number.
Now, help me understand, what would a spike be? Are we talking 3.5 to
0.5%? So 3.5 to 4.
Okay.
Right.
All right.
Or 3.6 to 4.1, something like that.
Got it. Okay.
But a significant spike in 1 month. I don't really see that on the horizon, actually. No. The economy's been pretty strong. So while we may get a recession, I think it's going to be, and I've been saying that for a year, it's going to be short and shallow.
Yeah. I actually think there's a better than 50-50 chance now we have the rolling recession.
Yeah.
actually means we never have a declared recession. I think those odds are increasing as the months
Yeah.
tick
Oh,
by.
yeah. Yeah, I agree. We may not have one at all. I mean, the inverted yield curve has always foreshadowed a recession.
Hmm.
So from that perspective, maybe there will be one, but again, it'll be short and shallow if there is. And by the way, the inverted yield curve, the recession doesn't happen until after it goes back above zero.
Correct.
And then
It
we're a long way
it
from that.
uninverts. Yep.
It uninverts, right? So I actually have a chart on non-farm payrolls that I'm going to show, which is interesting. All right, so that's last week. Next week, what we have coming up, it's going to be important.
Yeah.
CPI.
I think you might be underselling it a little bit.
Now, from this site that I use, they have not forecasted anything yet. I'm expecting the forecast to be 3.1 or 3.2, but it may actually be higher than that even.
Yeah, I think we have to talk about this. I've been warning about this number for well over a month, mainly because the base effect was our friend, and this month it's not our friend. Simply mathematically speaking, a 0.2 month on month will mean we're going to go to 3.2 because the
Right.
base effect for this month is 0.
It's actually a little bit negative.
Yeah, slightly negative, rounded to 0. Right.
Yeah. You can see it here. The base effect is this blue box. Basically, the CPI is calculated based on a rolling 12-month period window, let's say.
Yep.
So what that means is each month, as we add a new one, the one from a year ago rolls off.
Correct.
And you can see the one from last month was the biggest one. It was actually the peak inflation number.
Yep.
June of last year. So that's the one that rolled off, and we went from 4 to 3. That was a huge drop.
Yeah.
And you can see the 12-month and the rate of change for a headline and 12-month rate of change for core CPI right here. But the next one that's coming up next week, it's actually a negative, slightly negative. So what that is effectively going to do is make the CPI number look like it's going higher.
Yep.
So that's why I said there's no forecast yet, but 3.1 to 3.2 is what I'm expecting to see.
Well, I think 3.2 just mathematically works, but if you look at oil and gas, I mean, do you have the commodities charts?
Let's look at that. Yeah, right here.
Oh, look at this number. Oh, yuck.
CRB, gas, and oil. All of those last in this month that will be reported next week, screaming higher.
Yeah, it's not good. I don't know that the market's set up for 3.3 or higher. I think the market knows, probably doesn't freak out at 3.1. I think 3.3 or higher, the market's like, uh-oh.
Yeah, well, the Fed raised in their last meeting, as was expected, quarter point. But if these things play out, if we get 3.3 or even higher, now gas and oil, gas has rolled over a little bit in the last week, but the number will be forecast or will be reported based on what happened last month, which was a huge increase in all of these.
Yeah.
So the Fed could be back on the table again for September.
Well, I don't know if you saw this. I think it's Mickey Bowman, Fed president, came out and said very clearly she sees more rate hikes with an S, not hikes.
Right.
Coming.
Yeah.
So, this whole one and done thing.
This report next week will give them cover to do that.
Oh, absolutely. I mean, that's my fear. And it's been my fear for 6 weeks. I've been warning this is coming.
Yeah. And you look at that on top of the summer slump, summer doldrums.
Yeah.
The market, has gone much higher. Here's my weekly chart. Now, I said way back here when we were watching to see if this big red candle was going to result in us going below this 38.2% Fibonacci level. We stopped right at it and started higher. And I said at the time, there's a lot of congestion right in this area between 41 and 4,300. And for a couple of weeks, these are weekly bars, by the way. So for a couple of weeks, we just kind of bounced around sideways. for almost a month. And then we took off, and it's just been almost straight up since then.
Yep.
So you can see what happened last week. And I said also at the time that 4,600 was really the line in the sand for the market. That's the point where the market is going to have to decide what it wants to do.
Mm-hmm.
Is it going to continue higher to all-time highs, or is it going to, get rejected here and have a significant sell-off?
Okay.
Now, I don't think there's a significant sell-off coming. I still think that we're going to get to all-time highs by the end of the year.
Mm-hmm.
But you can see how big this candle was last week.
Yeah, that's kind of red.
The biggest one since way back here in March.
Yeah.
And it ended right at the lows,
Mm.
which means, again, look at psychology of traders. This is what I covered in my class a couple of weeks ago.
Mm-hmm.
If you look at that candle, it ended at the low, which means the only reason it didn't go lower is because the market closed.
Yep.
So we have, with all the things coming next week and being in the summer and everything else, and earnings coming to an end pretty soon,
Mm-hmm.
I think it's pretty likely that we're going to be selling off.
Yeah. I'm curious.
Now,
You talked earlier in the kind of lead up to this about the Fitch downgrade, and you had some charts from 2011,
yes.
which was the S&P downgrade. Do you
Right.
have that?
I do. Next week, by the way, is PPI, and CPI is on Thursday.
Mm-hmm.
So that's
Thursday,
something
Friday.
to watch out for.
Yep.
Yeah, this was in the newsletter this week. So here's the Fitch. Here's the S&P downgrade from 2011.
Ooh, that's ugly.
Right. So right here, it's almost to the day between the S&P downgrade in 2011 and the Fitch downgrade. Almost exactly the same day.
I'm trying to get a sense for scale. So we're kind of at 1,200-ish, 1,250.
Yeah, this was probably around 1,225, 1,200, 1,225 roughly.
Kind of
And
violent down, but that's
market
really
went down to 1125. So
call it a 10%, 8% swing.
right. So initially
pure
it sold
chop.
off. Initially it sold off. This is a daily chart too, by the way.
Okay.
So initially it sold off, and then this is the summer again.
Mm-hmm.
See what happened right into October.
Yeah.
October is where the lows usually get put in.
Mm.
But for most of the summer, it just kind of bounced sideways. Went down initially, went up, down, went up, down. And this is what I'm expecting to see this summer.
Okay.
Same thing. But then, once we get to October, just took off.
Yeah. Okay.
So here's where we are now. So this was the S&P downgrade from AAA to AA plus.
Mm-hmm.
And here's the Fitch downgrade from AAA to AA plus. So we're just starting in this downward trend right here.
Yeah. Okay.
And I think we probably could get down to 4,400.
Okay.
Somewhere in that range, 4,400 to 4,450, somewhere around there.
Yeah. So the downgrade, S&P downgrade was roughly 8 to 10% move, and then chopped all summer. And you're kind of feels like you're saying that you wouldn't be surprised if that happened again.
Yeah, exactly.
Okay.
So this is the daily chart for the S&P, and this is a Keltner channel. So these are the average true range, these different colored bars in here.
Mm-hmm.
So the darkest one in the middle is 1 day's range. The next one is 2 days, 2x. The next one is 3x. You see, when it usually gets to 3 or 4x, it doesn't stay there very long.
Right.
It usually reverts to the mean, which is the 21-day moving average down here. Mm-hmm. So this is what happened a couple of weeks ago, the end of July. This is also, I'll show the NASDAQ chart for the negative divergence, because that's the thing that I was watching. Okay. So this is the S&P. So we came back down to reversion to the mean, and we've now fallen through it. Mm. So we're at the bottom of that dark one. Again, on the downside, when it gets down to 3x, or if it even gets to 4x, you can see here it's never, except for way back here in September, it never even got to 4x, made it to 3x, and then bounced back up. Okay. So we could get down here to 4,400. I don't think we're going to go much lower than that, at least initially. Okay. So we'll see what happens. We ended the day on Friday at the lows,
Right.
again, implying that there's more downside to go. If we look at the same thing with the NASDAQ, this is where the negative divergence is much more apparent.
Mm-hmm.
So you can see here where the market made a new high, the NASDAQ made a new high right here.
Yep. Yep.
But the momentum indicator, PPO and the RSI was just very slightly lower, but the PPO was pretty dramatic.
Right.
PPO made a lower high. So this is a momentum indicator. So that implies that the rally is running out of steam.
Mm.
There's not enough buyers left to sustain this uptrend. And I pointed this out a couple of weeks ago and in my newsletter that there's a negative divergence and we have to be careful because it's rare. It doesn't happen very often, but when it does, it's usually pretty reliable.
Right. I remember.
And now we're getting the sell-off as a result of that.
Okay.
So now we'll have to see how far it goes. Now, again, we're right in the middle of the range, and this could get down to about 14,800, somewhere down in here.
Hmm.
So, but I'm expecting over the summer, the next couple of months, for this just to bounce around in here, go up and down. So it'll be a difficult trading period. So for those folks that are traders, you need to be very alert. You can make some money because you can catch it the upside and the downside.
Right.
But you've really got to watch what you're doing. For long-term traders, this is just noise.
Yeah.
You know, if you're in it for the long term, I think the market's going to continue higher. So
Yeah.
I wouldn't be taking on any new positions if I was long-term right now.
Okay.
I would wait and see, what happens in October. And I think we're going to probably be going higher in October.
Okay. I like that.
This is we looked at this. This is the non-farm payrolls number, and I've got headline CPI, PCE, and the Fed rate, and all of those are kind of converging at the same place up here.
Yep.
But the interesting thing on this chart is non-farm payroll 12-month rate of change down here.
Mm-hmm.
It's slowly going down, but not very quickly. It's kind of flatlined.
Right.
And then the 3-month rate of change, again, also very slowly moving downwards. So the economy is still strong. It's going in the direction that the Fed has been wanting it to go.
Yeah, the Fed appears to be, I think we all laughed and joked about the soft landing a year ago. But hey, let's give them props. Maybe it was luck, dumb luck. Who cares? We would have blamed them before. It certainly looks like a soft landing chances are increasing.
Yeah, I think so. I think the Fed would like this to go down quicker. And that's why they'll probably continue with rate hikes. The one down here.
Real quick, have you changed your opinion about rate hikes? Do you think July was the last one, or do you see another one or two?
I think based on depending on what happens next week with CPI and the fact that oil and gas have spiked higher, I think there's a good chance of a September rate hike.
Okay. All right.
And then after that, if we go back to this again, you can see the ones that roll off then slowly. The next one, so this will be the September report, is not very big. So this might bring us back to 3.
Yeah.
Right. We might go to 3.2 or 3.3, and then in September go back to 3.1, something like that. And then we'll start to drop quicker again.
Yeah, we get a couple good months. Yeah. Okay. Very cool.
And I think you said the housing numbers come in at that point too, right?
Yeah. Yeah. Housing on the core gets better starting in August. So not this print, next print.
Right. And by the way, this is for annual members on my website. I've got all these charts in here. A lot of the charts that I'm showing you now are here, so you can always see them in real time. But one that I just added was a 30-year fixed rate mortgage.
Oh, nice. Let's take a look.
Chart. So this is over 33 years. And interestingly, look where the midpoint is over the last 33 years.
Yep.
Right where we are.
Yep. There we go.
So
very cool.
Even though it seems like it's high, it's actually right about, in the middle.
Yeah. The problem is that, rightly so, not only do we have high rates, well, we have high prices, and that's the affordability has rarely been lower than it is today. It's
Yeah,
tough, and that's why we're doing 4 million homes, not 6, because affordability is so bad.
right. Yeah, and that's the 30-year fix affects that.
Oh, no question. It's yeah.
You
There's
know,
only
by the way,
three
the other
things.
the other thing reported in the jobs number was an increase in wages. So wages
Yeah.
are not helping the Fed.
No, I agree. I've been calling for wages to see years of increase. Wages went up 0.4% month on month, 4.4% year on year. Real wages are up, not only nominal. Real wages only been up for 3 or 4 months, but they are now going up. So I think we have years ahead of wages being going up in real terms, not just nominal.
Yep, we very well could.
Yeah.
Absolutely. Real quick, just to take a look at the sectors and
Mhm.
see, based on rotation.
Mhm.
Again, this is in my site. This is probably the first thing that I look at beginning of each week. I've got end of day Friday all the way through 1 year sector performance. But if we look at 1 week, you can see that the ones outperforming were energy, financials, industrials, consumer staples, materials, healthcare, real estate. And
Yeah,
a lot of those are defensive
for
sectors.
sure. Yep.
Even though they show negative right here, they are actually outperforming the S&P.
Yeah. Less negative.
Right, less negative than the S&P.
Yep.
And you've got communication services and technology, which are the two most aggressive sectors, down below,
Yeah.
underperforming. So
Very good.
that's not a good sign. If we go back 1 month, now we can see, again, energy, financials, communications is still in there, industrial and healthcare. So going back 1 week to 1 month implies that there's rotation
Yeah, for
moving
sure.
out of technology and communication, which is where the internet stocks are.
Hmm.
Now, the good news is that it's not moving to cash necessarily.
Ah,
It's
okay.
moving to defensive sectors. So the money is roughly staying in the market, but it's getting more defensive. So what that's saying is big traders are seeing that, again, the summer slump probably going to go down or go sideways for the next few months. So the thing to watch when we get into early October is whether this rotation starts to go back to the aggressive sectors.
Okay.
And if that happens in October, mid-October to late October, then I think we are going to scream higher by the end of the year. But we have to
And
wait to see.
and now let's play the other side. So if that's what you expect, obviously you flip it over, it goes the other direction. What might happen?
Well, if it goes the other direction, then I think it's time to be defensive.
Okay.
If it goes into defensive sectors, that's telling us that the big traders,
Yeah.
it's leaving a footprint for what they're doing.
Got it.
And we want to be following the trend, whether it's up or down. So
Right.
if the trend is down and the big traders are moving to defensive sectors, then we should either be moving to defensive sectors as well,
Okay.
or shorting, or just
Yeah.
move to the sidelines and move the
Yeah.
cash.
Don't
Right.
fight
So
the trend. Yeah.
that's the key with watching these sectors.
Mhm.
That's really what they're meant to do, is to help you understand what the big traders are doing, what the big mutual funds and hedge funds and the ones that are, spending millions and millions to buy stocks and sectors, what
Yeah.
they're doing, so that we can get advance warning on what the market's going to do.
Very, very cool. Well, this has been a lot of fun looking back. I now want to go and start looking forward. What is the setup for next week? Dan,
Yeah,
one
I
more time,
also
show your website.
in the next session, I also want to take a look at two stocks and look at earnings reactions. What happened after earnings and what happened with their stocks.
I can't
It's
wait.
actually very interesting.
I can't wait, folks. Go to breakpointtrading.net. One more week of getting the email newsletter, and it won't be no more. Go get it on his website, breakpointtrading.net.
It's
Thank you.
Yeah, it's free to get the newsletter. It's free. I don't ask for a credit card or anything like that. All you have to do is
Nope.
register your email. You do have to register the email to get the newsletter, but there's
Yep.
other parts on the site that are free. Like there's a book section where I have book recommendations. Anybody can get to that anytime.
Awesome. Thank you so much.
Okay, you bet.